This is Satya Pradyuman of Cirrus Research. The latest issue of the Industry Outliers is out. The title, Acceleration in Industrial Spending to Weaken the Nifty 7 Dominance. We've done a lot of work on industrial in the last 18, 24 months. At the heart of this is this belief that industrial spending is likely to accelerate or continue to accelerate. We continue to witness that, and when it comes to the market follow through, it's been very mixed. Where we've seen the broad markets, the industrial spending has really benefited the industrial exposure in portfolios. This has failed to materialize in the last 6-8 months in the large cap area. If you take a look at this chart here, this is a look at the relative performance of the industrials and technology sectors. The upper panel represents the smaller firms, that's mid, small, micro. What you'll notice is a massive outperformance in the last 2 years by the industrial sector. Notice the smaller technology stocks have really gone dormant and really flatlined in the last 6 to 12 months. So the performance gap there has opened. Notice, however, while this was really in about 21 to 22, this started to occur in the larger cap arena. That has since reversed, really since the start of the year. And so the big question here is, which way does this go? Does it mean that the smaller cap firms will follow or vice versa? Based on the underlying spending data, we would argue that this gap that's open in the smaller cap arena will continue and expand into the larger firms. Some of this data is really why we're making the case. When it comes to the CapEx spending data, what you'll notice is the technology spending data has flatlined. It's not terrible, it's just not accelerating. Whereas the depressed industrial spending data had begun to really accelerate, and it continues to. The lower panel relates to basically the revenue curves of the sectors in the portfolios. The growth rates in sales has materially slowed, whereas in industrial spending, it's somewhat stable. Mind you, this was occurring as the Fed had really materially tightened. So this is, I think, very constructive. Underneath this is a longer-term view that in a world of higher oil prices, industrial spending tends to dominate. We go back to the 70s, and there's evidence of it. Take a look at the report. Feel free to reach out to us with any questions. Thank you.